we've had some really not encouraging jobs reports in a row, and this is a good one. I mean, on the surface, you always got to dig down deeper. We're not all going to feel the same way about this economy or this labor market. We have hundreds of millions of workers who have very different circumstances. There still are people out there looking for jobs that aren't finding them. They're not going to be upbeat and positive about this. And for many things, whether it's inflation or unemployment, like this has been a really rough ride. So being told from a statistic that's very abstract, just some number that pops up on the screen that you should be happy, is not,
Right.
These are feelings, not the numbers. But this is encouraging, and this, we need more of these, right? Because we've had some disappointing ones, but this is in the right direction.
10-year real yield up 8 basis points. We've gone from a 156 to a 1.72 in 2 or 3 days as well. The Sweeney yield explodes out up 16 basis points. All you need to know is the word ginormous, 3.87%. Paul Sweeney, the 10-year yield, we're going to get to a 3.95%.
Yeah, big moves in the yield space, Tom. So, Claudia, just the headline numbers for the people that care. Unemployment rate, 4.1%. That's down from 4.2%. Average hourly earnings up 4% on a year-on-year basis versus 3.8%, actually revised up to 3.9%. So, I mean, the headline numbers for a lot of folks out there, pretty solid here.
Yeah, no, these are good numbers. This is a good report, so I'm not, again,
is
I'm
the
sure
Fed is the Fed gonna read it that way?
Well, I think the Fed also smiled when they looked at this one, because the inflation is coming down. That is part of getting back to 2%. We're well on our way. Unemployment is low, the maximum employment, that's the other side, and then they should be out of the way. The Fed has interest rates. They are still high. You can look at interest rate sensitive sectors, and the Fed still is having an effect. It is not, their job is just to kind of keep things together. They're not supposed to be trying to push the economy one way or the other in just normal times. So the closer they get to checking both boxes on the dual mandate, great.
Dr. Sahm, thank you so much. We're going to leave it there. Really, really appreciate it. Claudia Sahm with us this morning with all her good work for economics that we've seen this year. Our economic indicators, the future's up 27, big lift to the market. Our economic indicators always brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to Commonwealth.com to learn about our consultative support, their technology as well. Again, futures up 24, Dow futures up 100. VIX was a 20 level off Eastern Mediterranean angst into 19.51. Gold 2663. Gold actually comes in a solid $15 as well. Really interesting jobs report, and a good time to speak with Ellen Zentner, Chief Economic Strategist, Global Head of Thematic Macro Investing, Morgan Stanley, their global investment audience. Ellen, thank you so much for being with us. This is a solid economy. Bring this right over to real GDP.
Yeah,
Are we 3-ish forward?
It's still 2 and change. Yeah, it's still 2 and change. I mean, if you look at this report, it's on the back of these phenomenal upward revisions last week to gross domestic income.
Yeah, Claudia mentioned that as well.
Stronger consumer spending and income growth and a higher savings rate. So we didn't even have to draw down the savings buffer in order to get that stronger spending. And where are we spending? We're spending on services. Where was the rebound in this report? In services. I think the decline in manufacturing jobs is something to keep an eye on. But this was a big rebound in services, and the services side of the economy is still strong.
Ellen, how do you think our Federal Reserve is going to view this data point here today?
Well, favorably.
Yep.
Look, there's ample room to cut, to use Chair Powell's own word. And so given that, the bar is not particularly high to go 50 basis points if the data warrant. This is not data that warrant it. Do people care about this report? I've heard that a lot from people because the next employment report released during blackout is going to matter. It can help them make a game time decision. But so far, the data flow does not. It supports Powell's baseline, which he laid out earlier this week with pretty much 25s.
And a red headline just coming across the Bloomberg terminal: traders shred bets on 50 basis point cut in November after jobs data. So maybe leaning a little bit more towards 25 here. What does this say about the U.S. economy? Because as Tom was mentioning before, you get numbers like this, and it kind of goes to a lot of folks out there who are concerned about the U.S. economy, that maybe it's a little bit stronger than we think. How do you guys think about the economy overall?
Well, look, I think this is always the case, right? We get this restatement in data, whether it's just the 2-month net upward revisions in this report or all of those benchmark revisions that came last week. Oftentimes these revisions can suddenly make us realize that we're sitting on an economy that is different from what we thought before. The foundation is stronger. Now, that doesn't mean that the risks are to the upside versus the downside. I think that the higher we run, the greater the risk is to the downside when companies do shift and decide they don't want the higher anymore.
Ellen Zentner with us with Morgan Stanley, so she could be with us, Morgan Stanley Global Investment Office. We welcome all of you across the country. Since Lisa Mateo gave us the numbers, there is a bid to the market. Futures up 24, now up 33, up 0.6%. NASDAQ up 0.9%. Small caps up over a stick right now. The VIX comes in solid in a big figure, 19.19 on the VIX. And yes, there is dollar strength as well. Ellen, I got to go to a bigger, broader picture here about the unknown unknowns. You've been exquisite at this for years out of Texas. And the basic idea is there's a productivity mystery, there's an immigration, migration overlay. Yes, all wrapped up in the election. Do we have any confidence within our traditional models now as we see a 254 plus revision?
So here's what makes forecasting payrolls really difficult: when firms aren't laying off. When there's a lot of volatility in jobless claims and you can see them rising and falling, it translates well into modeling employment growth. When jobless claims are just sort of low and steady, you're trying to simply model the rate of hiring, and that's much more difficult. And also, Tom, 200,000 is one standard deviation on the payroll report. So I can tell you at more than 250,000 in today's print, I'm pretty confident it was positive this month.
You mentioned, some new revisions to GDP, higher corporate income, muted labor share. This got to be good for just overall profits in the marketplace.
Productivity drives profits. This is a productivity story because you pair those revisions upward in growth in the economy to what we know is going to be a downward revision to employment when we do get those benchmark revisions. That's stronger productivity, and productivity drives profits. And it explains how margins are holding up well. It explains the earnings surprises. It brings, in a bizarre turn of events, it's bringing the economy to the markets.
Hey, Paul, I just did the math. Here we are. You can see this on YouTube. On radio, I'm holding up the famed HP12C. The only reason Ellen Zentner first talked to me a zillion years ago was I showed her my HP12C. And here's the answer. Impressive. The 3-month moving average, Paul, went from 116,000 to 185,000 with 254,000 plus a solid revision of 95,000. I mean, I'm sorry, revisions got the wind going here.
Yeah. So, I mean, Ellen,
185,000.
That gets your attention there, and HP12C cranking along still. I got mine June 16th, 1986.
I have my HP graphing calculator.
Oh, that's geek. That's serious geek there.
Did you ever have a Monroe Trader?
No.
I mean, you go darken Jim Caron's door at Morgan Stanley. He'll explain the glory of a Monroe Trader. Paul?
Yeah, but now we've got the Bloomberg terminal. Macro investing. When you see a print like this, when you see an exceptional U.S. economy like this, how does that how does that influence Morgan Stanley's view of the global macro investing here?
Well, I think that there are a litany of risks out there from the global economy, and the U.S. exceptionalism. Right? Dollar strength.
Yep.
The weaker the global economy is, the more you're going to drive investments to dollar-backed assets. We talk about trade and uncertainty around trade. Everyone thinks that that's going to be a weaker dollar under a Trump presidency. That's a stronger dollar. All you have to do is look what happened in 2019.
DXY out to 102 right now. Euro goes under 110. Weaker euro, 109.83. You pay through the nose in Dublin. I'm in Rome. It's gonna be perfect in Rome.
I know.
I'm gonna walk by Gucci and Balmain, and there'll be a store down via what's-its-name where they'll take my wallet with a weaker euro. Ellen Zentner, I want you to tell us about your new duties at Morgan Stanley with Morgan Stanley Global Investment Office. What are you doing now?
I thought maybe you would run out of breath listing out my title.
Well, they had to give you a big title.
It's lengthy.
Consultant. Yes.
It's really lengthy.
Right. Does that mean you're doing less?
I wish. I have really enjoyed being a part of the Global Investment Committee now for Morgan Stanley.
Right.
It's important to have a macro voice that can talk to longer run thematic trends, that can talk to dynamics around productivity and growth and how companies hire, and trying to close that gap between understanding markets and the economy.
I mean, within that, let's go right to productivity. We've got capital dynamics, labor dynamics, and I'm sorry, it's a huge mystery in our modern total factor productivity. Is it just a polarization of America into the haves of productivity and the have-nots?
Well, total factor productivity, which is the productivity from technological enhancements, that is the most difficult piece of productivity to measure. And it's one reason why when I was moderating Chair Powell earlier this week, I was trying to see how he felt about those revisions that GDP and GDI are up, but employment is going to be revised down, so that's greater productivity, and understand whether that is some sort of, post-COVID, normalization or distortion, or is it something AI? And you just can't say that it's technological advancements yet. I am in the camp of being very positive on what technological advancements from AI can bring us in terms of productivity. So I can tell you that productivity is much higher than we think right now. When we get that data, we'll see that. But I can't tell you that it's something that will be sustained.
I mean, Paul, as simple as this, if you got a run rate 2.8% real GDP, for the haves, is real GDP 3.5 or 4% China-like GDP, and for the have-nots, they're in recession. It's as simple as that.
Yeah, I don't know the answer to that. Yep.
Well, the have-nots have been in recession for some time. Gas prices coming down so much has helped buying power, but of course we'll see if this pop in oil prices is going to last, because about a 2-week lag it starts to show up in gasoline prices. And also lower interest rates from the Fed. Whether it's 25 or 50, interest rates are coming down. And while the market price is in the entire path of Fed easing, the rate you pay on your credit card moves as the Fed is cutting rates. And so with strong job gains, especially in the service sector, and some of these other positives, you can put a floor under lower income households here.
I mean, Paul, what's so important here is Zentner's never talked much about she wins this trophy, this one, this prediction. She's like Steve Stanley over at Santander. They got all these awards
all the
on
hardware,
on the fireplace in the second living room. Ellen, you won those trophies off a view of the consumer. What is the state of the American consumer with 254,000 jobs created?
Well, with this pop in services sector, right, this rebound in service sector jobs, we see that wage gains and job gains continue to be positive for lower income groups, but they are still battling with higher rates of food and housing inflation, and wage growth is strong, but it has been slow. But they're in better shape than they were. And then the wealthy households are just on fire. No slowdown there.